Okay, so have you ever noticed something absolutely bizarre happen in the financial world? A brand new US jobs report drops, right? It shows hundreds of thousands of people just got hired. The economy is buzzing. And suddenly, the stock market triggers this massive, completely counterintuitive sell-off. It just moves sharply, unpredictably, and often in the exact opposite direction you'd think it would. Well, welcome to this explainer. Today we're going to untangle this incredibly strange phenomenon of US labor market data and its super volatile relationship with the stock market. Okay, let's dive into this, because it's really the core contradiction of modern investing. I mean, why on earth would robust economics news, like data showing strong employment and wage growth, send Wall Street tumbling? It literally feels like the market actively punishes macroeconomic success. But as you'll see, there is actually a cold, hard logic to all of this madness. Section 1, the labor market paradox. Basically, why good news is actually bad news. To really understand this paradox, we have to recognize that labor data isn't just a simple headcount. It's more like dropping a giant boulder into a pond. It creates this massive macroeconomic ripple effect. This one piece of data dictates aggregate consumer demand, it impacts corporate profit margins, and most importantly, it heavily influences inflation and the monetary policy of the central bank. So ultimately, it alters the fundamental valuation models of the entire stock market itself. Moving on to Section 2. Why jobs drive economic growth. The domino effect. Let's move to and see how this builds, starting with the traditional happy path expectation. It's a really straightforward domino effect. You have high employment, which drives robust consumer spending. That aggregate demand then translates directly into business revenue and long-term corporate earnings expansion. And, in a vacuum, higher earnings per share support higher stock prices. That's exactly why healthy labor data is fundamentally viewed as the bedrock of a strong economy. Section 3, the inflation and Fed connection. And here comes the plot twist. So here is exactly why that seemingly perfect cycle of job creation makes institutional investors sweat. In a tight labor market where hiring is super aggressive, workers are scarce. So to attract and retain talent, companies are forced to hike wages. And look, while that's fantastic for Main Street, this extra capital fuels explosive consumer spending, which leads to a classic wage price spiral. And that out-of-control inflation, that is Wall Street's absolute worst nightmare. Enter the Federal Reserve. You already know them, the US Central Bank. And they have a dual mandate: keep prices stable and maximize employment. So when the labor market gets a little too hot and inflation spikes, the Fed is legally obligated to step in. They basically have to act as the chaperone who takes away the punch bowl just as the party's really getting going. And how do they cool the economy? They deploy their blunt force instrument, raising interest rates. This is like dropping an anvil on the financial system. Capital suddenly gets expensive, debt servicing costs for businesses absolutely soar, and consumer credit slows down. Crucially, higher risk-free rates mean those future corporate profits are deeply discounted in today's valuation models. If you think back to the really aggressive 2022 and 2023 rate hike cycles, this is precisely why a blockbuster jobs report can trigger an immediate market sell-off. And this brilliantly illustrates the constant macroeconomic tightrope we're walking. A booming job market definitely fuels economic growth, sure, but it simultaneously guarantees higher inflation and higher interest rates, which are the exact forces that crush stock multiples. So every single time that monthly jobs report drops, algorithms and millions of investors are instantly trying to calculate which side of this scale carries more weight. Section 4. When weak data boosts stocks. Welcome to Bizarro World. Okay, now let's flip the script. On the surface, weak employment looks like a pure 100% negative indicator. Rising unemployment traditionally signals recessionary fears, lower consumer spending, and shrinking corporate earnings. By all traditional logic, rising joblessness should definitively hurt stock prices, no question. But here is the crazy counterintuitive twist. Weak jobs certainly signal slower growth, yeah, but they also signal to the Federal Reserve that the economy is cooling off. And this instantly increases investor expectations for a dovish pivot, meaning the market thinks the Fed is going to cut interest rates to stimulate the economy. Because cheaper capital artificially pumps up equity valuations, the market will frequently rally on terrible labor data. They're basically cheering for those sweet, sweet interest rate cuts. Section 5. Finding the Goldilocks economy. Not too hot, not too cold. Now, what's really interesting about this slide is the balance it shows. If a booming job market terrifies investors with inflation, and a shrinking one scares them with a recession, the ultimate goal is this Goldilocks economy. It's the delicate balance of not too hot, not too cold. Markets are absolutely desperate for healthy, sustainable job growth combined with just moderate wage expansion. just a boring, steady climb that completely avoids the need for aggressive Fed interventions. So, to measure if we're actually in that Goldilocks zone, analysts obsess over 4 specific monthly metrics. You've got the headline non-farm payrolls and the standard unemployment rate. But crucially, and pay attention to this one, institutional money closely watches average hourly earnings. It's literally the ultimate cheat code for spotting wage-induced inflation early. Finally, the participation rate reveals how much slack is actually left in the labor force. Together, these paint the definitive macroeconomic picture. So, the crucial point is that the market's seemingly chaotic reaction to employment data hinges on one core investing truth. The stock market is a forward-looking, discounting mechanism. Honestly, it couldn't care less about what happened last month. It only prices in future growth, future inflation, and the future cost of capital. Which brings us to the core takeaway from all of this volatility. As the old market adage goes, the stock market doesn't simply ask, are jobs strong or weak? It asks, what do these numbers mean for inflation, interest rates, corporate profits, and future growth? Individual reports are just tiny pieces of a vast macroeconomic puzzle. Long-term investors really must focus on this bigger picture instead of getting shaken out by the algorithmic, knee-jerk reactions of the daily market. Because once you grasp that hidden tension between jobs, inflation, and interest rates, market volatility transforms from total chaos into calculated prediction, which leaves you with one vital question for your own portfolio. Are you constantly reacting to today's data, or are you strategically positioning for tomorrow's expectations? Thank you so much for joining me for this explainer. Keep looking at the bigger picture, and I'll see you next time.